Well, hi everyone, it's me again. As you can see, the seasons are changing. I am not here today in Hustle Fun t-shirt, but on this wonderful fall day, we are going to talk about follow-on fundraising. So what do I mean by that? Well, when you go and you raise money, and let's say that you have some investors who come in, and then you go out and raise more money, and you ask existing investors, do they want to participate or not? How should you think about that? How should you think about their responses? And the other thing I'm also going to address in this talk today is the flip side. If you are an investor, should you be doing follow-on investing? And the reason why this topic is so fascinating to me is I hear so many myths out there. I think so many people get this wrong on both sides of the table, where I hear investors saying you should always follow on into your winners. And then on the flip side, I hear founders saying you should only work with investors who will follow on, or it's bad signaling if your investors don't follow on, and things like that. And these myths could not be further from the truth. So today I'm going to, open this onion or whatever the metaphor is and start to dig into why people say these things and where they come from. But as always, it comes back to first principles of trying to figure out for this particular person, whether it's an investor or an entrepreneur, and this person's particular situation, what should you do? All right, so let's dig into this and get into specifics. First off, let's look at it from the investor side of things, and then we'll talk about the founder side, because I think the investor side of things illuminates everything for everyone, and we're going to dig into some numbers here as well. So there's an old adage that a lot of VCs tout, which is you should always save room in your fund for follow-on. In fact, lots of VCs go around saying you should save at least a third, if not a half, sometimes even 2/3 of your fund for follow-on. And that may or may not be true, depending on what kind of fund you have and what kind of stage you're investing in. But to say it as a blanket statement, to me, is just simply wrong. Like everything else, it really depends on what kind of fund you're running. The other thing is, not only are there rules around how much you should be investing on follow-on, but there are also rules about when you should come in and this and that. And again, like everything else, it depends. Okay, so let's start from basic principles on the investor side. How do you make money in this business of investing? Well, you put in money, and then you hope that if the company has a liquidity event of some sort, you get your money out plus more, and you hope that that multiple is as large as possible. That's it. That's what you hope for. And so really, I think the key word here is multiples. Multiples are determined by the entry point of your check and the exit point of your check. So what do I mean by that? Let's actually dig into some examples here, and I have my handy dandy whiteboard. So let's see if we can get this going. All right, so we have my whiteboard here. Okay. And let's just start digging into some examples. So let's say that we are going to invest 100K. And let's say actually that we're an accelerator. So we invest 100K for 10%. So this is effectively a 1 million post-money valuation. Okay, great. Now we hope that the company is selling for $1 million. And depending on what that number is, that's pretty much how we can figure out our multiple after accounting for dilution or other investors investing in us being pared down in our shares. But let's just say that this company, let's say the next day after we invest, so there are no additional investors who come in here, the company sells for, let's call it 50 million. Exit. Oops, that wasn't very clear. 50 million. Great. Wonderful. I wish that could happen every day. So what is our multiple here? Well, this is a 50x multiple, and the way that we compute that is just, in this case, 50 million divided by the 1 million post-money valuation that we got in at, and that's a fixed 50x multiple. Now, just note, because of dilution, you cannot always just do this ratio like this, but for for all intents and purposes and simplicity of this example, we're going to just leave it as such. Okay, so that's one company. Now let's say that you know, this again was an accelerator, but let's say that in this accelerator there was a fund who came in and met the company, and at this point, let's say that this is, you know, a YC startup or something like that. At this point, the investor's coming in after the accelerator, and so actually he or she's getting in at a $10 million post-money valuation. And so again, if we have, you know, a $50 million exit the next day, then you know, this is not going to be a 50x multiple. This is only going to be a 5x multiple, assuming no dilution. There are no other investors in here. Okay, great. So we understand now, like, how returns work, roughly speaking. Like, this is determined by your entry point and exit point. This is not rocket science, so hopefully everyone could follow along here. All right, now let's dig into some more examples. Okay, so now instead of one company, I think it's really important to think in terms of portfolio construction. And this is something that is critical for every investor, which is you're going to have a basket of portfolio companies. You're not just going to have one portfolio company. And so let's say that you, let's take a different example. Let's say that we have a $1 million fund now, and we're going to invest in a slew of companies. And let's say that we're running a different accelerator, and we put 100K into 5 companies. So, you know, 4, 5, we put in 100K. Okay, great. They're all 100K. They're all equal. And let's say that we're getting in at a $2 million post-money valuation. Okay. All right. So in total, we are getting 5% of each of these companies, all 5 of them. And we are allocating $500,000 of our $1 million fund, as you can see, because we have 100K here and here and here and here and here. So 5 of those is, you know, 500K. All right. Now we have a remaining 500K left in the fund. Now we have to decide, what are we going to do with this money? And this is where the decision-making process for follow-on gets very interesting. You cannot just blindly follow hard and fast rules. So there are a few things we can do with this. Just very simplistically speaking, we could continue the same strategy. So take this other $500,000 and do the exact same thing that we did before. So we can get, you know, into 5 more companies and get, you know, 5% each at the 2 million post-money valuation. So now we're running an accelerator of basically 10 companies. So that's one option. Another option, though, of what we can do with this money is we can actually follow on into one of these companies. Now, you know, let's say that our accelerator is really great. We provide a lot of value. Our companies are, you know, increasing their revenue, and now there are a whole slew of investors who are interested in our companies. And so let's say here that actually one of our companies is now raising at 10 million post-money valuation. So many investors want in, and the valuation has gone up 5 times. Okay, so we have a choice. Founder comes to us and says, we love you and we would love for you to follow on in this round. We have allocation for you to put in $500,000. And for that, you can, you know, get 5% on this 10 million post-money valuation. And so now we have to make a choice. Do we choose door number 1 or door number 2? Remember, we have a limited amount of capital, so we can only pick one of those 2. And you know, in real life, there are obviously more choices. You can mix and match or do all kinds of other crazy things. But for the simplicity of this example, we only have 2 doors to choose from. We can either say we're going to decline our allocation and we're going to continue to run our accelerator and invest in 5 more companies. Or we can say, actually, we know this company is really breaking out. We've gotten to know the founders over the last few months, and things are going so well there. We think that this equity is really valuable, and we're just going to plunk all the remaining money in the fund in this one company. So the question is, which would you rather have for the $500,000? Would you rather have 5% in this existing company where you know the founders really well, you've worked with the founders, you have a lot of information on the business, and so you have some edge more than any new investors. You have edge here in making your decision. Or do you say, actually, we're going to pick 5 new companies that we know nothing about, but seemingly promising, kind of like how we picked the other companies, and basically we have 5 shots on goal. Which is the better door to pick? And I think the answer here is, like, in all honesty, I can't answer this question in this hypothetical example, because there are certainly some cases where I felt, oh, it is definitely better to pick number 2. We know so much about the company. They have hit product market fit. Like, this is definitely going to be a unicorn. But in most cases, I would say, in my own personal experience, that isn't clear. And that often it is better to pick door number 1. So in my experience, most of the time it's better to pick door number 1, because going from pre-seed to seed, things are not clear at all. But on occasion, it is good to go with door number 2. And so this is where, like I said, all of these things really depend a lot on the circumstances of the fund, a lot around the particular businesses, whether they're really breaking out, etc. But I think it's important to illustrate this, because let's then bring it back to the original questions of, should you always follow on? Should you only accept money from investors who follow on, et cetera, and answer all of those all at once? Because this situation is a situation that early stage investors face every single day. And it's a very common situation, and I don't think most people think about it correctly, if I'm going to be honest. So let's talk about this here. First off, on the investor side, as we've just illustrated here, it's really hard to say whether you should be allocating 2/3 of your fund or even half of your fund towards follow-on. This example shows exactly why it is not clear to me that you should be pouring your $500,000 into one company. And in many cases, if you think about outcomes and the probability of outcomes, the higher that valuation is pre-product market fit, and that's an important distinction. This doesn't apply to Series B investing, but pre-product market fit is going to be harder, right? Like, if you want 100x at this point, now you're talking about, this has to be $1 billion exit if you plunk in the $500,000 at this point. And so it isn't, that is really hard to do. There are not that many companies that exit for over $1 billion. So this is a tough decision that you have to make. And I would say most of the time, especially if you're running an accelerator, it does not make sense to follow on. I would say for almost every, certainly pre-seed or accelerator fund, in most cases, it makes sense to go out and invest in new companies, because per the valuation considerations and concerns, you are most likely going to get the higher multiples on those earlier lower valuation checks. That's just how the probability kind of unfolds. Now, of course, one would argue, well, unicorns are not about playing the probability game. And so, this is where, again, it's really hard to say. But if you are investing at slightly different numbers, let's say we were not getting in at 2 million post money, and let's say that we were getting in at 8 million post money, which is better here? Now, obviously the numbers don't quite work out as nicely, but if it's a difference between 8 and 10, then that's a very different scenario, because your initial check was coming in fairly close to your second check. So you're not paying up that much, but maybe you have learned a lot of information since then. So that's a second consideration for early stage funds. Now let's look at it a bit from the founder side of things. Well, when you look at this, actually, I think this earlier example, if I turn it back to 2 million, it is pretty similar to, I think, what accelerators get. the 2 million post money has gone up a little bit these days, but it's like 2.5 or thereabouts, depending on the accelerator in many cases. And so what you're looking at here is like, this is exactly the reason why your accelerator probably isn't doing follow-on investing. Is that bad signaling? Well, no, they're not known for being a follow-on investor. And so therefore it isn't negative signaling if they don't, because that's just not what they do. So I think when people say, well, it's bad signaling if your investors don't follow on, I would say actually in most cases for your accelerator or pre-seed or even seed funds who only do, seed investing, it is not a negative signal at all. Where it becomes a negative signal is there are a lot of bigger funds, Series A funds, that are now coming down and doing a bit of seed investing, but they make their money at the Series A or the Series B. And so if they are writing a check in your seed and not participating in the stage that they are known for, that's a problem. So it's all a matter of take a look at the particular investor. What do they typically invest in? Not what are they investing in right now, but what do they typically invest in? What is their bread and butter investment? And is it negative signaling if they don't do that bread and butter investment? And the answer is yes, that would be negative signaling. So if a Series A investor is investing in your seed, you are an option to that Series A investor. That is not the bread and butter of that Series A investor. And so he or she is not participating in the Series A or whatever stage we're talking about, then that's a problem. And so if you want to mitigate negative signaling risk, one way to do so is just not to take money from people who are known for investing in the next round after you. Or if you do, bring in multiple people like that, so that way if one or two don't invest at the next stage, then that's okay too. But that's how I would think about negative signaling and who's doing follow-on or who's not doing follow-on. But the fact that your investors are not doing follow-on does not mean that they don't believe in you. It doesn't mean that it's negative signaling, etc. I mean, I think a good example of this is angel investors are never questioned why they didn't follow on. And the reason for that is angel investors as a group of people are not known for following on, even though I'm sure a number of them could if they wanted to. That's just not what angels typically do. So again, as a founder, look at it based on what is typical for that fund. So this is how I think about follow-on investing, whether you're on the investor side or the founder side. But don't listen to those myths. People just have hard and fast rules that generally don't make sense for much of anything. You always have to go back to first principles about what is actually going on, underneath the hood. All right, thanks a lot.